The S&P 500 ended yesterday fairly strongly with anticipation for market cuts over the next few days, but our focus is going to be on Microsoft, which we deem to be the perfect dividend stock for any portfolio. Now, this is a company that is up over 800% over the last 10 years, significantly outperforming the S&P, and whilst we do see it have a fairly trivial yield of 0.7%, they continue to return excess cash to investors, not just by those dividend increases, but also by share buybacks, which we are going to run through today. Now, we also note at this moment in time, Wall Street do consider this a strong buy. We also see a buy from Seeking Alpha, although we have a hold from Quant. And towards the end of the episode, we will take a look at the valuation and our own price target. We also note the forward P does sit around 32.7, which is higher than the S&P, right now sitting around 24. Now, what makes Microsoft great is you could consider when investing in this company, investing in an ETF. They have a wide range of products and services, not just the classic Microsoft 365 that you may know, but also many others, including their cloud services. They have management integration services, even cyber security, and one thing that isn't mentioned on here, their gaming revenue stream as well. On top of that, with all of the talk about AI, we do in fact know they have a strategic partnership with OpenAI, a software that you may have used over the more recent days, and we can also see not too long now before they release their Copilot AI features, and this will go alongside their Microsoft 365, and we can in fact see these will be coming to both new Intel and AMD laptops in November. So a lot to get excited about in terms of AI, and hopefully they can execute this very well into their services, something that we do believe will show them a lot of upside in their numbers, their top line, bottom line, as well as what we want to talk about today, ultimately returning excess cash to investors. The way they've done that, well, in fact, they announced a 60 billion stock buyback. This was just yesterday after market close, and that is the largest ever repurchase that they have performed. We also note, very important, very nice to see here, a double-digit 10% increase to the dividends, something that we have not just come to love with this company, but also expect, as we will take a look to see that in terms of their metrics. Now, we just want to very briefly look at this company, explain why we believe it is the perfect stock, and the first thing that we want to highlight is their consistency in beating analyst targets as well as management expectations. So what this shows, over the last 4 quarters, they have beaten management. In fact, the more recent one, whilst it was a very trivial of 1 cent, nonetheless, that is a 100% track record. And over the next 4 quarters, they are anticipating 3 of them to be double-digit increases to the earnings per share on a year-on-year basis. And as we can see, for those that like to look out into the future, June 2026, if they hit that 15.29, the forward P will come down to 28.2. And again, if they do continue this theme over the longer term and you invest in this company right now, could continue to come down in that respect. Then another thing that we also like to point out, when we do compare it to some of their competitors, well, over the last year, they are up 32%, pretty much around the lower end of this industry. Nonetheless, still very impressive, as we will come to show you, this has outperformed the S&P over the last 12 months. Over the last 5 years, whilst it isn't at the top of the pack, we still note 231% looking very strong. And over the last 10 years, this includes reinvesting those dividends, you would be up 962%. Now, whilst we always say that past performance is not an indicator of the future, we do believe that moving forward, Microsoft will at a bare minimum be able to outperform the S&P. As we will show you, this is something they have consistently done. So over the last 12 months, in comparison to the S&P, they are up 32%, the S&P up itself 26%. When we expand this to over the last 5 years, again, that is some significant outperformance, 231 versus 88, and over the last 10 years, as we can clearly see, 960 versus 184. Now, moving forwards, why we do believe this company will continue to outperform, as we have seen, they have moved into AI. There are ways that they will be able to generate extra revenue on their top line alongside those other revenue streams that we have come to love with this company. and just by showing you their metrics, it will paint a clearer picture. Now, firstly, we just want to highlight for those that love their dividend scores, it does get a 99, which is the highest score obtainable, and this does mean it is very safe. Some other metrics that we do love, in fact, as we mentioned, an increase to the dividend this month, a double-digit increase to the dividend on average over the last 5 years, and a double-digit increase to the dividend over the last 20. So already it does look like a very strong dividend growth company. And one of the reasons they have been able to do that is because when we do look at the free cash flow payout, we note it is significantly below 60%. In fact, it's been decreasing 30% in 2024, 32%, so around that same level for previous year, and therefore we would be very surprised if moving forwards they are unable to keep up with that double-digit increase, something that we have been spoiled with as investors in this company. Moving on in terms of what we also like to see, increasing free cash flows. Again, we note over the last 10 years, they have more than tripled that number from 290 to 997, and the expectation moving forwards is to continue that upward trend to around $10.30. And as we mentioned, we do believe moving into this new AI revolution with OpenAI, with their Copilot and other ways that this company is looking to expand on this, we expect them to continue the double-digit increases to their top line, which we have seen for the majority of the last 10 years, 16% in fact just in 2024. We also like a lot, in fact, the return on invested capital, not just because it's above our minimum 10%, but we're talking about 30% over the last 3 years, and just generally over the last 10, we do get to see a lot of consistency in what is one of our favorite metrics. On top of that, you will have heard it quite significantly if you do watch this channel. We like to see operating efficiency. That is when the margin increases over time. So what Microsoft has been able to achieve, not just an increase to revenue, but also increase to their operating margin and free cash flow. As always, this is a free cash flow machine, and they have managed to consistently have very strong numbers, which is always good. Do remember, sometimes it is worth paying a little bit of a premium or having a small margin of safety for companies that do bring out numbers consistently every single year, as well as every single quarter. We then also want to highlight our final metric for this company is that the net debt to EBITDA, which does correlate to the balance sheet strength, telling us that they have an absolutely phenomenal balance sheet. Whilst we want to see it below 3, in fact, been nowhere near that over the last 10 years. 0.17 in 2024, 0.15 over the next 12 months, and these are ultimately the number of years it would take the company to pay off all of their debt net of cash on hand. As we said, very, very strong balance sheet. Now, it isn't just us as investors who do believe this is a high quality company. When we take a look at institutions, there's quite some large ownership there at 71%, and whilst they have been selling around 65 billion over the last 12 months, we notice a significant amount more of buys, 107 billion. This is over the same time period, and we also note over the more recent quarter, 14 billion buys versus 11 billion sells. Whilst we never copy what the institutions do, this does go to show that institutions over the longer term are liking Microsoft and have been adding this to their portfolios. Now, before we do jump into the valuation aspect, we also want to let you know that we have released our latest free weekly article. If you want access to this or any others, you can grab a copy by clicking on the pinned comment below, where you can also get access to our 25 undervalued stocks for your consideration for the month of September. And we also talk about each one that sits within our own portfolio as well. And on top of that, we have released 22 dividend stocks that have the most upside, and that is definitely one you should go and have a look and see whether or not they fit into your own portfolio. So do click on the pinned comment below to grab those copies. Now let's get into our valuation part for Microsoft. And as always, if you do enjoy the content, value is being provided, smash that like button as well as hitting that subscribe and bell button so you are continually notified of the videos as they drop. Now, our intrinsic value in today's episode for Microsoft does come to $462. How we got this? Well, we did run it through 3 different models. The first one being the multiples valuation. These are companies in a similar sector and size, where we have their average PE multiplied by the EPS of Microsoft to get our first intrinsic value showing undervaluation. Now, bear in mind, we don't look at any one of these models in isolation, and we do conclude towards the end very shortly. The second model, the dividend discount model, as we can see, very nice growth. As we mentioned, pretty much double digit every single year. Now, we have gone a lot more conservative at 7.25, and as we can see here, a second undervaluation signal. We then gone for the DCF model where we have the free cash flow update for 2024. Now the average growth of 14%, we've gone for around 15 moving forwards in line with management targets, and we can see that is also lower than the more recent year of 25%. When we use the discount rate, we then get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and then we have our intrinsic value. So 3 undervaluation signals. As always, remember you can grab a copy of this model by clicking on the pinned comment below to put your own numbers through, whether it's from Microsoft or any others. Now, speaking of Microsoft, our intrinsic value of 462 is the average of these 3 models, and what we always like to do on this channel is use a margin of safety. Now we start off with 10% and we execute on that if it meets the 3 golden criteria. As always, that is a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, it is a buy around $416, which ultimately means right now this company isn't sitting at that level. For those that want to see what level it is, well, currently right now, based on the increase that we have seen, this is looking like a 5% MOS. Now, for some people, Microsoft may be a company that they are happy to have a 5% MOS. For others, this may be one to dollar cost average in every week, every month, given it is one of the highest quality companies that we currently see. But again, everyone will have different expectations, different investment thesis. And for those that want to see at a 15% MOS, a buy at $393, at 20% around $370, and that 25 around $347. Although, as we said in today's episode, a 5% MOS at the value of $438. We also know Wall Street do have a price target of $505. They see upside of 15%. And as we saw at the beginning of the episode, they do give this a strong buy. As always, do give us your thoughts. Let us know whether or not you do believe Microsoft is a strong company, whether or not it's in your portfolio, and if you are looking to add this to the watch list. As always, don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do cover our weekly buys and sells. As always, have a great day and we'll see you all on the next one.